You can start trading with more money, lose more money, and then eventually when you're broke and alone, you figure out how to actually trade options and start making some money. Totally not speaking from personal experience. It is October 27th, almost October 28th, and this is the video log that takes 30,000 to a million. Today, I'm going to tell you, show you, help you to get started on option trading with Robinhood, because I believe is the easiest platform to do options trading out there in existence at the moment. So it should be fun. At least it was fun for me. It is fun for me. So yeah, I'm just going to show you the account real quick. Technically, I'm at an all-time high, but I'm not going to celebrate it too much. I'm sitting at 73,682. I made an all-time high video last time where I was sitting at 73,600, so not a big gain. I'm not going to celebrate. I'm just going to skip right through it. Pretty much just the account. Apple made some gains. I only got like $100. By the way, I'm speaking a little bit nasally because I'm sick, so or I think there's been some smoke and pollution in the area, so maybe I'm just doing that, or some allergies, whatever. But anyways, I didn't get all that gain because, as you know, I have, or may know, I've sold an option here that is killing me at the moment, but is acting as a hedge for me, so I'm not too worried. So I'm only collecting about 100 and some odd dollars worth of value from that Apple all-time high here. EXK is only moving $7 up. I'm expecting big things from that. Looking to exit from C-SPAN. Blah, blah, blah. Nothing much happening. Uranium, waiting precious metals. Uranium's a little bit up. Everything's great. All right, moving on. So that's it. If you want to take a look at these, I don't know, pause, slow down, let me know. So what I'm going to do here is I'm going to give you 4 basic strats, or 4 basic things that you can do to start on option trading. All right, you can do this, of course, on any broker. I like to do it on Robinhood. You should like to do it on Robinhood because it's the easiest, I think, I believe. So here are the things that we're going to do. Number one, what you want to do before you start doing anything options, and this is, by the way, we're going to be able to do this with a very small account of money. A small account with not a lot of money in it. So what you're going to start referring to your money in the account, you're going to start referring to it as your capital. All right. So you're going to start talking about things like capital requirements, all right? Or I want to build more capital, all right? And you're going to have to start calling yourself a capitalist. Those are basically the requirements, the first requirements of option trading right there. Start using some financial terminology. All right. So what you're going to start with is you have to start answering a question. So you take a look at a stock and you got to try to determine what you think is going to happen to it. Is the stock going to go up? Is the stock going to go down over a given period of time? Is it going to move sideways? Or is it just going to have some kind of erratic movement that you don't know which way it's going to go, but you know that there's going to be an erratic movement? So you can start with those 4 basic questions, all right? And then after you've answered this question, which is the most important question, and if you answer this question right more than 50% of the time, you will get basically hired by, anyone to make anyone a crap load of money, all right? So if you're able to answer this, that's like 99% of it. The other 1% is knowing what to do after that, and I'll help you get started on doing what you got to do, all right? Wow, I'm so excited today. I'm starting to sound like a run-of-the-mill YouTuber. It's really weird. So, all right, I'm going into browser, and I want to show you. Here are the things, okay? So here's what I'm going to tell you. We're going to learn how to buy a call. So if you think that a stock is going to go up, or equity of some sort, you're going to be buying a call. That's the simplest way to play this, all right? There's many, many ways to skin the cat, and as you get into options, you're going to start answering more and more complex questions. But for right now, we're going to keep it simple. This is a beginner's guide, all right? Just dipping your toes into it just to build some confidence, all right? So expect to lose a lot of money. So if you're not willing to lose money learning, then I don't know, just buy ETF, that index ETF of some sort, and just sit on it and keep piling money on it. This is gonna have a large learning curve. Even if you have the best technical setup, you're gonna lose money. That's how it works. Okay. Until you get burned enough times to figure out what works for you. It may take years, it may take 5, 10, 15 years. So get ready to lose a lot of money. Hopefully you're playing with a small account and you're young, so that you get to learn all this stuff while there's still not a lot of money on the line. And I would probably play with a small percentage of your net worth. Net worth is your assets minus your liabilities. So for example, if you have 1,000 credit card debt and you have $2,000 in the bank and nothing else to your name, your net worth is 1,000. 2,000 minus your credit card debt, $1,000 net worth. Okay, so hopefully you're playing with a small percentage of your net worth. Now you're not going to be able to play too much with $100, right? So but if you're young, you don't got much to lose anyways. You have your whole life ahead of you, and you're gonna earn a lot of that money back. And $1,000 now is probably not gonna seem as much to you when you're older, and it's gonna be money well invested. All right, I'm blabbering too much, so here we go. So if you think the option is gonna go up, you're gonna do something like you're gonna buy a call. If you think the stock options or equity option, whatever, the option is gonna go, the equity or the stock is gonna go down, then you're gonna be buying a put. If you think that there's gonna be an erratic movement, you're gonna be buying a straddle or a strangle. You're gonna set that up. It's a multi-option strategy. And if you think that the stock is not going to go anywhere and you're just going to sit flat for the time period that you'd have designated, then you're going to enter into an iron condor. Now, I have videos on all these, so if I remember, I will add links to them in the description. But so far, when I've said this, I've forgotten to add it, so you might have to just search through the channel, or don't even search through the channel. Go find it from some other YouTube guy and learn from there. But those are the questions you want to answer, right? So if you think the stock's going to go up, let's say the S&P 500, we're going to try to do some options with the SPY, which is the ETF that tracks the S&P 500. ETF means exchange traded fund. And you're going to have to start, with the lingo. You can feel free to replay this information as many times as you want. You can pause, look at things. I'll try to go slow, but mainly this is kind of a guide, not an in-depth tutorial on how to set up one of these trades. It's just what you need to do if you're bullish or bearish. That means you think the stock's going to go up or down, or you're indifferent, or you think it's going to be flat or it's going to have an erratic move. All right, so there we go. That's the most important section of this video. All right, if you think it's going to go up, you buy a call. If you think it's going to go down, you buy a put. If you think it's going to have an erratic movement, you set up a straddle or strangle. And if you think it's going to stay flat, or not flat, but the same price or flat, you do an iron condor. That's it. That's the most important thing. Okay, so here's how you're going to set up. I'm going to do just a really brief overview of how to do it. Like I said, check out other videos or my own if you want on how to set up each one of those things. And that should get you started. All these 4 strategies are meant to be executed without much capital up front. Okay, we're going to look at some of the costs in a little bit. So here we go. All right, so we're going to go to the SPY, which is going to be our trading vehicle for the moment, for today. And on Robinhood, on the phone, you just press options here. Once you click on the SPY, on the browser, you're going to press this button right here, trade SPY options. All right, it's going to bring up the screen over here. Now, the first thing you're going to do is pick a date. Now, I know that most of you are going to be super impatient and you can't wait for more than a week for your options to play out, because every new trader is short-term minded. Very big mistake, but just get out of your system, just make as many short-term trades as you can, lose all that money, because you're probably going to lose, and then eventually you're going to wisen up after 5, 10, 15 years and going to start doing long-term stuff and more complicated stuff. So, but for right now, I know all of you don't want to wait for more than a week, so here we go, November 1st, which is 1 week, actually for like 5 days. And what you're going to do from here now is you're going to play around the current price, the current share price. All right. If you think that the stock is going to go up, what you're going to do is buy a call. Whoops. So these buttons over here tell you, what you're going to do, right? You have basically 4 settings here, or 2 settings for each button, right? So we're going to buy a call around the share price that it's currently at for simplicity. And you're going to buy a call. Anything that you buy on this page is going to serve the same function here. So it's all bullish. So if you think that stock is going to go up, we're just going to call it the stock for right now, even though it's a collection of like 500 stocks. Any of these buttons would work. So just click a random button, hopefully around the share price for simplicity, and just go like this. Just click it, continue. All right. You put number of contracts, 1 contract, and 1 contract plays with 100 shares each. Okay, so you get 100 to 1 leverage basically. So you're gonna just do 1 contract on this for right now, and don't worry about this stuff. It just sets the limit price and the expiration of the trade, but you don't need to worry about that as a beginner here. You're gonna lose a lot of money, so min-maxing right now is not gonna be your number 1 worry. Just review the order, okay, and it tells you to submit it. All right, and it tells you what's gonna happen here, and then submit. I'm gonna cancel because I don't want to initiate this order. Okay, so that's how you do it. All right, submit. You can pick anything. All right, you can pick this one here. The difference between all these, just real quick, is we're gonna have to factor the break-even cost here, right? So you pay more money the further down you go for a lower break-even price, which means that the stock has to go over 303.44 for you to make any money, right? Now, if you select this one and pay up $204 instead of $144, then the stock will have to go only above 303.04, so $303.04 instead of $303.44 for you to make more money. So you pay up more money for a lower break-even price. All right, more money, lower break-even price. You can just think of it like that. Now, the second thing we're gonna do. So that's if you think that the SPY 500 is gonna go up. Now, the second thing we're gonna do is, let's say you think that the SPY is going down. So what you may want to do through options is you're gonna buy a put. All right. And again, same thing here, except in reverse. So just gonna pick any of these buttons, the one that suits you best. All right. Remember, the more expensive one has a higher chance of making you money. It's set up like that. All right. It's intentional. It's by design. It's not a bug. It's a feature. Okay. So if you think, and there's the break-even point right here. So you're just gonna click one of these buttons. All right. Hopefully around the share price. Boom. I clicked this one, the 301, and contracts 1, and then you just press review, and then you can submit if you want to actually go through with it. It's going to cost you $130, and it needs to pay off. If it doesn't pay off, both these buying puts and calls will expire worthless, and you lose all of your money. So these $130, if what you want doesn't happen by the end of the week, by Friday, November 1st, you lose it all, man. You lose everything. So be prepared for that. And that's going to happen a lot. And that's why you don't just do it willy-nilly, okay? You have to have a good reason for you to buy puts and calls. But all you're going to do it anyways. Lose some money. It's fine. It's healthy. There we go. Buying a put. Now, again, these buttons all do the same thing. They're all viewed as bearish. Okay, which means you think that you're negative, you think that things are going to go down, and the more money you pay up, the higher chance that you're going to actually make money here, because the break-even price is higher. All right, and you want it to go below that number to make money as when you're being negative. All right, so that's buying a put and then buying a call. So now we go to the straddle strangle. which means that there's going to be some kind of a dramatic move, but you don't know what it is. All right. So what you're going to do is you're going to go to November 1st, and you're going to do two options. All right. You're going to basically buy a call. All right. And let's say you take that same price, same strike price, and then you're going to just buy a put. All right. So now we have a strangle. Okay, it's a two option strategy. It's the second most simple strategy here, besides just buying a put or buying a call. Here's what it's going to cost you, $274. All right, so keep in mind, all that's gone if the price stays where it is right now by November 1st. All this money is gone, okay? It needs to go over under 299.7 in this case if you're going to make money off of the put side, and it needs to go over, or it needs to go over 303.44 in order to make any money on the call side. All right, so remember, you have to make more than that. So if it's 303.45, you're not going to make up for the fact that you just bought a put as well. It needs to be higher than that. It needs to make up for the premium that you paid. It's called a premium. All right. So here we go. We're going to cancel that order. I'm going to uncheck these. I'm going to start over. So that's buying a straddle. What the strangle means is just there's some distance between the two options. Okay, that's all it is. It's basically the same thing. So let's say buying a call. Let's say I buy this one, the 302 call over here. I'll buy this. And then instead of buying that same strike price of 302, I buy a 300. All right, and you see it's a strangle. All right, it's the only difference. It's still betting on the same thing, except it's a bit cheaper. As you can see over here, I'm saving a little bit of money. I saved 30 bucks. However, the window I have, for my dramatic move is smaller now. All right, next. So that's straddle and strangle. If you want to know a more detailed video, you can check out some of the other ones or check out someone else. I don't care. Let's say iron condor. So this is the most complex one out of all of them, and this one you want to do when you think things are going sideways. Now notice so far we haven't needed more than $274, right? So you can play the SPY, you can play the S&P 500 options, which is kind of an expensive stock, right? It's $300. So the nominal value matters. Nominal meaning the number, the actual digits. This is for beginners, so I gotta explain these things. But you gotta start speaking like this, because people know what you mean. So when you're in some trading communities or whatever, people will know, or finance forums, people understand you better, and they know what you mean. Okay, so the iron condor, the most complex one. What you're gonna do here is you're gonna pick the date again, of course, and you're gonna set up two credit spreads. Okay, so you're gonna do four options real quick. This is how you do it. You are going to sell a call anywhere above the price, boom, and you're gonna buy a call right above that, boom. Then you're gonna sell a put below this, boom, and you're gonna buy a put right below it, boom. Did you get all that? Look, Robinhood knows what I'm doing. Iron condor right here, $1. One contract. Guess what that cost you? $61. That's it. Okay, $61. $61 only to set up this trade, and you're betting that S&P is not gonna move outside of a specific range. Okay, if it stays within this range, it's not gonna cost you that. It's this is the credit you're gonna get. I'm sorry about that. This is how much you're gonna receive if the S&P 500 doesn't move. Okay, so there we go. It requires $100 collateral. That's what it's gonna cost you basically. Okay, it requires $100 collateral. Disregard what I said about $61. It's just going. That's how much money you're gonna get if things go your way. All right. So that's the iron condor. Let's go over it again. Okay. We're gonna go over it again. I'm just gonna clear everything. Just gonna go home and clear it. Okay, so I go to SPY, just real quick. There's a whole nother video on it if you want to slow it down. Trade options to set up an iron condor. Pick a date, November 1st. See what I'm doing? Now I'm gonna buy anywhere really. Okay, I'm gonna sell a call anywhere. It can be all the way up here. Okay, sell a call, and I'm gonna buy one right above it. Boom. Then I'm going to sell a put all the way down here if I want to, and then I'm gonna buy a put below it. So there's the iron condor again. This time I'm collecting less credit because, why am I collecting less credit? Because they're further apart, right? I'm giving myself more window for the S&P to stay within. Okay, it's a higher chance that it's going to stay within this window. So that's why I'm receiving less money for my credit, and I'm probably going to have to pay the same amount of collateral. Let's see. One contract. Review order. There we go. See, same amount of collateral, but I'm getting less money for it. Almost half, because I'm giving myself more room. Okay, that's the iron condor. Now, bonus round. What's the bonus? It's just call credit spread and put credit spread. This is basically one wing of the iron condor. You already learned how to do it. Okay, you already learned how to do it. So here it is. Go to SPY. And we just do one of the wings of the iron condor. We sell a call. Let's pick November 1st. Always. The date first. We sell a call. And then we buy a call right above it. And look what it says up here. Call credit spread. Total credit $23. It's probably going to ask me for the same amount of collateral. Let's see. Enter one contract. Review order. Oh, $50 collateral. Look at this. Winning so far. Oh, that makes sense because two options, iron condor. $100 collateral makes a lot of sense. So this is pretty cool, right? Now, what kind of question are you answering though here? All right, this is your test. What kind of question? What kind of guess are you answering here? Well, think about it for a while. What do you want to happen here if you are doing a call credit spread? I'll give you some time. Well, you're betting that SPY is not going to go over 302.5 by November 1st. That's the answer that's the question you're answering right there. All right, that's your bet. That's the bet you're placing on the table, okay? You are betting that SPY is not going to go over 302.5 by November 1st. You're going to receive $23 for your trouble, and you're going to risk $50 to do that. Okay, that's your collateral. All right, make sure you learn that word as well. Look it up, Google it. Okay, so if you're a pro options trader, you know, this wasn't the video for you. That's cool. I do some more advanced stuff later as well. But you could be more advanced than me. Who knows? Which is totally fine. Now, that's the call credit spread. Let's undo this. And let's work the puts. You pick the date. We're going to sell a put. And then we're going to buy one underneath. And look what it says over here. Put credit spread. One contract. Minimum credit. So we're going to receive $24. We're going to put up $50 as collateral. Same deal. So what are we betting on here? We're betting that SPY is not gonna go under $300. If you think SPY is gonna stay over 300, you can place this, put credit spread, and receive $24 by risking 50. All right, that's the bet. That's the bonus round here. There we go. So you can get even more complex than this, but this should be a really good launching pad. I mean, these options, these 6 things will last you for quite a while. All right, just keep working on those for a while until you get used to it, lose some money, start understanding how options work, and after that you can design some more complicated things. All right. Now, Robinhood thankfully doesn't let you naked short and stuff like that. So it doesn't let you do any naked options. So which is really good for beginners. So you're not gonna lose the house, because it's very likely that you will lose the house if you try a big brokerage and you put a bunch of margin on your trades, and you're gonna lose everything and you're gonna be in debt for like the rest of your life. So don't do this. Stick to Robinhood. Learn these 6 things. Once you start learning all about it, you can look up and Google what naked, trading means, and from then you can start trading with more money, lose more money, and then eventually, when you're broke and alone, you figure out how to actually trade options and start making some money. Totally not speaking from personal experience. All right. Okay, that's about it. Hope you all are making a lot more money than I am. I'm super excited to get to 1 million in this account. And if you all have any questions about what I've been saying or anything more advanced, I'm looking forward to answering those questions because I'm finding this really fun. And I'm probably starting to sound like a stupid YouTuber. Although this is, just my hobby. Oops. Did I not show you this? Oh well. I hope I showed you all the credit spreads and stuff like that. Did I mess this up? I don't want to do it over. I don't do any do-overs. So every single mistake, which happens a lot, I'm going to post, and I'm going to make sure that everyone knows how much I mess up and how much other YouTubers mess up and have to redo things. It's how much work it is for them. So, yeah, that's what it is. Let's go over it real quickly. So, sell a put. You got to pick the date. Sell a put below, buy a put below that. And now we have a put credit spread, betting that the price will not go under 300. All right, that's the put credit spread. The call credit spread is on the other side, mirror image. Okay, you just take one of the wings of the iron condor. That's it. Lower collateral, just as much credit really. All right, and you can do all these things with very little money in your account. You don't have to be rich. As you can see, the most expensive thing here that I did was costing me $274, which are the straddles and the strangles, right? They're the most expensive ones, but you can still make bets on one of the very high priced, stocks thing or ETF, whatever, out there, which is $300. Obviously, you won't be able to play with Amazon if you only have 1,000 in your account, but you can at least make 3 or 4 SPY trades until you run out of money. So you can have fun with that. That'd be a nice learning experience. Plus, you could get lucky. Maybe one of them will hit, and you can think that you're a hot shot, and then you'll have 5 or 6 trades that you can lose money on before you learn your lesson. All right. With that said, I'm gonna end it right here. Hope you all are making a ton of money. Peace out.